All right, everyone. It looks like the majority of people are here, and I want to be respectful of everyone's time. So we're going to get started here with our webinar for February on how new and proposed legislation could affect your financial life. Many of you will know my voice. I'm Dave Clayman, Chairman, Founder, and CEO of 12 Points. I'm joined by Francesca Federico, the President of 12 Points, and an advisor.
Hello, everyone.
Oh, sorry, Francesca, an advisor to many of you. And we are extremely honored to be joined today by Preston Rutledge, the Honorable Preston Rutledge. He is founder and principal of Rutledge Policy Group, LLC. He is most recently the Assistant Secretary of Labor for the Employee Benefits Administration of the Department of Labor. Prior to serving the administration, he was a Senior Tax and Benefits Counsel for Chairman Orrin Hatch on the majority tax staff for the Senate Finance Committee. Before joining the Finance Committee, he was a senior tax law specialist on the headquarters staff of the Tax Exempt and Government Entities Division, the IRS, and a senior technical reviewer in the Qualified Pension Plan branch of the IRS Office of Chief Counsel. So obviously extremely well qualified to speak to us here about the changes coming in retirement plans. And thank you, Preston, for being with us today.
Well, thank you very much. I'm really pleased to be here. Thanks for inviting me.
Absolutely.
And I would also add that he is a veteran, so we'd also like to thank you for your service.
Yes,
thank you.
All right, so let's get right into the meat of this so that we're respectful of everyone's time. First and foremost, I know that you were integral in the creation of the Secure Act. So can you tell us a little bit about what changes have already come from the Secure Act and what still needs to be enacted?
Sure. So let me set a little context because I think it's always helpful to understand, because sometimes the policy provisions and the legislative provisions in isolation might look a little detached from reality. There's really four things that policymakers in Capitol Hill, legislators, and really in the agencies are trying to do these days. They're trying to make it easier. They're trying to increase the number of employers that have a 401k, for example, and I'll just mention 401k as a sort of a proxy for the defined contribution world. There's still a lot of employers that don't have a plan at all. So step one is to encourage more employers to have those plans, because that's when people really save for retirement, when they have a plan at work. The second thing is to get the employees to join those plans. Well, we call that coverage. And then the third thing is to get employees, once they join the plans, to increase their savings as their salaries rise, for example, or as they have more ability to save. We call that escalation, accumulation of assets. And then fourth, once they reach retirement age and they have hopefully a decent amount of money in an account, we need policy provisions to make those assets last a lifetime if possible. That is the whole goal of retirement security, is income for life. So it's access, coverage, escalation, or I should say accumulation, and then lifetime income, or decumulation, some of the policy nerds like to say. So the Secure Act, I'd say the two biggest things it did in that regard it created something known as the pooled employer plan, which wasn't legal before the Secure Act. Basically, what that means is someone who is not the employer can set up a 401k and allow a large number of employers, that's called a multiple employer plan. And those employers might be customers, it might be a financial institution, it might be a bank that decides they're going to sponsor a 401k. And a number of employers can join, and it'll be the financial institution or whoever decides to set up this plan. It's called a pooled plan provider. Sorry for all the acronyms, but that entity will do all the tough work of running the 401k, all the annoying administrative details, all the IRS filings, the selection of the investment products that are up on the platform. The employer really, they just have to be prudent and smart about the pooled plan that they join. And then once they join it, they have to kind of pay attention to whether it's being operated properly. But it vastly simplifies the cost and the administrative burden for the employer. And that is the incentive for the smaller employers, especially, to join a plan. They no longer have to set it up. They can join someone else's plan. And if they already have a plan, they can also decide, well, we'll merge into this larger plan, because larger plans means larger asset bases, lower fees, a little better returns, better professionally managed assets. So for the world of those of you that are that work with 12 points, you're probably advising companies with plans. You may be a financial advisor. Another benefit of all this, besides retirement security, is it means more assets under management for the industry. So the pooled plan, the pooled employer plan was the first one, and the second one, and this has to go to decumulation. The Secure Act enacted a law that had been bouncing around a while called the Lifetime Income Disclosure Act, and that is simply the concept that once a year the 401k plan must send a notice to the participant, giving the participant a readout of how much monthly income their account would result in if they were to convert their account into a lifetime income feature, like an annuity. And the concept behind that is when people realize how much they've saved, if they've saved a lot, but then they think they've saved a lot, but then they see that maybe it doesn't create as much lifetime income as they want, they'll start saving more. I'd say those are the two big ones, the pooled employer plan and the Lifetime Income Disclosure Act, probably the most relevant for today's purposes that came out of the Secure Act, which, by the way, retirement plan legislation, often bipartisan, in the Senate, when it passed through the Senate Finance Committee, when I was there, 26-0 on a recorded vote, 26 members of the Finance Committee, 14 Republicans, 12 Democrats at that time. That's the very definition of bipartisanship. So this is a great area to work on if you like to see members of Congress working together across the aisle.
And anything left that still needs to be enacted from the Secure Act, or are we all there?
Oh, we're well, as some of the legislators like to say, you hear this a lot. Secure Act was a good first step. Let's move on. So there is a bill, and again, bipartisan, that's been drafted by the chairman of the Ways and Means Committee, Chairman Neal, and the ranking member, Brady from Texas, Neal of Massachusetts, Brady of Texas. And again, bipartisan. They've drafted a bill known as Secure 2.0. It's been nicknamed Secure 2.0. That's not the actual name of the bill, but that's what folks call it. And as I said, it's bipartisan. And it goes a little further in some of these areas I just mentioned. So once a plan exists, plans are allowed to do what's known as auto enrollment, automatically enroll the employee, and then the employee can opt out. But if you automatically enroll them, behavioral science tends to tell us that people stay where they're put. And when you auto enroll someone into a plan, the vast majority of the participants stay in the plan and begin saving. So what they've done in Secure 2.0, what they would do if it was enacted, would be to basically make the auto enrollment mandatory that the employer, when they set up the plan, has to automatically enroll everybody, but not mandatory that the employee has to stay. The employee can always opt out. So that will increase coverage. Auto escalation. The idea would be to require escalation each year that goes by, increase the amount contributed by 1% automatically up to a maximum of 10%. That would increase accumulations. There's another provision in Secure 2.0 that would help a lot with accumulations for people that are nearing the end of their working life and haven't saved enough. And it's called the catch-up contribution. You're all probably aware of the catch-up contribution that currently exists. It begins at age 50. The proposal on Secure 2.0 would add a new layer of catch-up contribution. When people reach the age of 60 and older, they could contribute an extra $10,000 a year. That's huge for people that have gotten toward the end of their working life and haven't saved enough. Another thing that will help with decumulation, allowing people to keep their money in the plan longer, they would increase the age at which minimum distributions are required. They're called the required minimum distributions. Those of you who advise plans know that when an employer or a retiree reaches a certain age, they're actually mandated that they start taking some of the money out. That age used to be 70 1/2. It was increased in the CARES Act last year to 72. And actually there was a moratorium in 2020. You didn't have to take anything out because of COVID. What Secure 2.0 would do would be to increase it further to age 75. That allows people that are able to do so to keep their money in the retirement plan longer. That also helps with assets under management, staying in the plan longer. Finally, they would completely exempt accounts of 100,000 or less from any minimum distribution requirement at all. $100,000 or less, no minimum distribution at all. Those are the key things that the proposed law, Secure 2.0, would do. And as I say, it was bipartisan. It was introduced last year, and looking to see it introduced again this year at some point.
Very cool. Thank you. So you mentioned Chairman Neal already from the great state of Massachusetts. I know that there is some talk about an auto bill, auto IRA, auto 401k. Can you talk a little bit about your general thoughts on that?
So that you're right, and it's known that Chairman Neal's working on it. It hasn't been made public yet. We know I'm sure he wants it to be bipartisan. We don't know yet if it'll be bipartisan. Given the way the elections went, particularly once the Senate went all Democrat after the Georgia elections, the likelihood of some more forward-leaning policies coming out went up a little bit. And this might be an example of that. So from what we know about the drafting and the proposal, is that it would move there would be a mandatory requirement that an employer have a 401k, or if appropriate, a 403b, or even an auto IRA like the states have. But it would only be required for employees, from what we understand. The very smallest employers will not have to do this. Where they draw the line, it's hard to say. Would it be 10 employees or larger, 25 employees or larger? There's a sense it might be around the 10 employees or larger. If you look at the states like California, Oregon, Illinois, they all grappled with this when they set up their auto IRA plans. Illinois chose, I believe, 25 or larger. Employers of that size were required to plug into the auto IRA. The auto 401k at the federal level would look a lot like that. It would be a deferral only kind of plan, meaning the employer, while mandated to set up the plan, employer would not be mandated to put employer money in the plan. It would really be for the employee to save their own money, deferring their own income into a 401k account. That takes a little of the sting off of the mandate. That's probably the policy idea behind that. But that would really be a big, almost a game changer in terms of increasing the number of employers that sponsor plans, which is of course the first step in getting people to save for retirement. One other really big thing that we think might be in there, and this goes to the end of the working life point, the decumulation, the lifetime income piece. We expect that for the largest employers, maybe, again, where they draw the line, we don't know, but say 100 or more employees or something large or larger like that, those employers would also have another requirement, which is that the vested account balance of every participant has to have access to some kind of lifetime income product, 50% of the account balance. It's already permitted that a 401k account balance have access to a lifetime income product, but employers are often hesitant to add one to the plan. Complexity, they're concerned about fiduciary liability, even though the Secure Act, which was one of the things the Secure Act did, was give employers a fiduciary safe harbor for adding a lifetime income product. This goes a little bit further and would require it at least for 50% of the account balance. So that again could be a game changer for having our defined contribution system deliver lifetime income, which has always been the greatest. If there's a downside to the defined contribution system, that's it. It's that the lifetime income got left by the wayside to a certain extent.
And if I missed this, I apologize, but you said one of the things would be that they're talking about capping that deferral limit at just $6,000, though. That would probably be a little bit of a disappointment for people doing this.
I see what you mean, but if you think about it, that's where the IRA is right now. That's probably, if that's what they do. And again, like I said, we haven't seen the bill, but if that's what they do, it's probably again, this is going to mimic and look a lot like the state IRA programs, which and the IRA limit is 6,000. We'll see the details, but for people that haven't started saving at all, it's a great start. And for folks, particularly at the lowest income levels that have a hardest time saving anyway, this would help. And one other thing that the plan might do for the folks at the lowest income levels, in fact, I think we expect it, there's a thing known as the saver's credit, where a person, depending on their income level, below a certain threshold, they will get a tax credit if they put money into a plan, and then the government will add to it. It's almost like a government match. They could also make that provision what they call a refundable tax credit, and I hate to use lingo, tax lingo. What that means is, though, the money would go in even if you didn't have a tax liability. Of course, folks at the lowest income levels have the smallest tax liabilities. So even if you didn't owe taxes, or let's say you only owed $500 in taxes, you still might get $1,000 or a $1,500 contribution into your plan. That helps with asset accumulation, particularly for the lowest income cohorts. But as time goes on, if this does get enacted, time will tell, but those contribution limits could well go up, especially if the program really starts to take off and it becomes popular and it looks like it's really working well.
Great. So budget reconciliation, there's one going through right now. I'm sorry, Francesca, did I cut you off?
Nope.
Nope. So obviously there's the current budget reconciliation being considered right now that handles the budget that wasn't passed last year by Congress for 2021. When we chatted, we talked about the 2022 reconciliation likely coming in somewhere around October for the 2022 year. Talked about the fact the majority of administration priorities often show themselves in a first budget reconciliation that they're really responsible for. So what kind of things could we expect to see regarding retirement plans in there?
So in the budget reconciliation bill that is going through right now, I believe it might be passing on the House floor today, and if not today, then tomorrow. It has a couple of retirement plan provisions in it, but not the defined contribution world. It's a couple of defined benefit plan, traditional pension plan issues, and basically it's funding relief. There's a major provision to kind of rescue the multi-employer the union-sponsored pension plans of the country, which are kind of in a solvency crisis. There's some COVID-related pension contribution relief for single employer plans in there, and there's a special provision for a very narrow group of pension plans known as community newspaper pension plans, and there's some funding relief for them. But so that there won't be anything on the 401k front in the first reconciliation package. It's already been drafted, and we've seen that. But in the second bill, depending on the way things turn out after the first reconciliation bill is passed, it's possible that we might see Secure 2.0 in the next reconciliation bill, or the Chairman Neal's more forward-leaning proposals might be in there, or they may decide to do it through outside of reconciliation, do it through regular order, remembering that these are generally bipartisan proposals. There will be legislation passed at some point this year that's not done through reconciliation. There's an obligation at the end of the year, starting I think between August and September. The government's going to be forced to do something about the debt limit. Raising the debt limit requires legislation, not in reconciliation. But they will need to do the budget for the year going forward, the 2022 fiscal year. Not just the budget reconciliation, but also generally what we call there's generally an end of the year bill, and we expect that again this year. And that is usually a time when you might see some of the good ideas that have built up that are bipartisan get put into those end of the year bills. So there's no guarantee, and we do have another year, after this year, 2022, it's part of the 117th Congress. But I would think at some point we will see Secure 2.0 and maybe some of those more forward-leaning proposals from what we're hearing about from Chairman Neal's office.
Great. Department of Labor. You mentioned this is a big year for the Department of Labor. Not something we plan sponsors typically like to hear, but what does that mean in your standpoint?
Well, it means two things. Anytime a new administration comes in, there will be priorities that the new administration wants to promote. We're not 100% certain what those will be at the Department of Labor. Also, if there is new legislation, it will almost certainly require the Department of Labor to start writing rules and guidance and maybe even regulations to implement that legislation. So that will, if there's legislation this year in the pension area, those two things, that and the new factors of new administration, those two things will always create kind of a busy first year. But this year's especially probably busy because there were three things done in 2020 that the new administration wants to revisit and perhaps rewrite. And those are the three rules. There was a rule on ESG, investment factors, environmental, social, and governance factors. ESG, there was a rule on proxy voting. Plan sponsors, trustees of plans that own corporate stock, publicly traded corporate stock, have to pay attention to the proxy season because as the owner of the stock, the plan owns the voting rights, and a fiduciary of the plan has to decide whether to vote those proxies, and then if they vote, how to vote those proxies. And then finally, the age-old, I say age-old, the decade-long saga of the fiduciary duty rule will have to be revisited this year by the new administration because in 2020, the original rule, what we call the five-part test from 1975, was put back into the federal Code of Federal Regulations. So it's back. And there was an exemption that was published that took effect on February 16 that allows folks who want to get a commission for giving advice to a plan or a plan participant, if they're a fiduciary, they can do that without running afoul of the fiduciary, the five-part test fiduciary rule. The administration allowed the exemption to go ahead and go into effect on February 16, even though that happened after inauguration. And the sense there is they are going to revisit fiduciary, but they'll do it in a methodical way. They'll probably spend a lot of time behind the scenes this year. We'll probably see something late this year or next year. But I do believe early on we'll see something on ESG. And what I guess 401k plan sponsors should pay attention to is does the administration become so forward-leaning that they not just permit ESG factors to be taken into consideration when plan investments are being decided upon, or do they in some way push it, promote it, or even require it? That would be huge because the historic position of the Department of Labor going back decades, many decades, has been that a plan fiduciary making an investment decision has to focus first and foremost on the financial materiality of the investment because of the rule that they're supposed to be managing those plans for the exclusive purpose of providing retirement benefits. But that's a big one. It's also a huge political issue. It ties into climate change. And as you may have noticed, if you're watching the news about the new Biden administration, they're putting a climate-oriented, a climate policy person in just about every agency in the government. So they'll have one at the Department of Labor too, I'm sure, and this will feed into that. So that's what I would expect at the DOL this year. These things though take time. So I don't think it's like we have to worry that something's going to land on your head in the first 6 months, but you may see proposals in the first 6 months to pay attention to, and if they're alarming, you may want to weigh in on them, but they also might provide opportunities. I'm not one of those who thinks every regulation is an imposition or a burden. Sometimes they provide opportunities. If people understand how to take advantage of them, they can actually be quite helpful to your business model.
Cool. And then this is the one, obviously, we have a lot of plan sponsors on the line. So can you touch on the idea of converting tax deductibility for contributions to a single uniform tax credit, how likely it is? I know it's been mentioned on President Biden's platform.
Yes, it was mentioned during the Biden campaign. They put it up on their campaign website as a potential proposal. So a little history on this. The idea of converting the deferral and the deduction for making contributions to a 401k kind of came on the scene for the first time about a decade ago in 2011. And it was a proposal that came out of some academic work through the Brookings Institute. There actually was a hearing on the whole proposal at the Senate Finance Committee in September of 2011. You can actually still find that video of that hearing on, it was dated September 15, 2011, and you might see a much younger Preston Rutledge sitting behind Senator Hatch, only I don't have a beard in those days. Anyway, that aside, we had a very, very thorough hearing on it. And the things about the proposal were that, one, it would raise a lot of revenue. And the reason was, and which made it attractive to a lot of people, when a bill raises revenue, you can use that revenue to do other legislation. So things that raise revenue are always kind of potentially in play. Why did it raise revenue? Because the current upper tax rate, you get the deduction you get is based on the tax bracket you're in. And if you're in the upper tax bracket, that's the deduction you get. That's the value of your deduction. They were actually talking about a fixed tax credit of 18% across the board, regardless of your tax bracket. So for folks within a tax bracket above 18%, a contribution to a 401k would be much less valuable. So it was very controversial. At the end of the day, it didn't go anywhere, but there's a proposal out there. It had a hearing. Sometimes these ideas get put on a shelf and they come back, and that might be what's happening now with the new administration. But we're not sure that they're going to push it, and if they do push it, we're not sure of the details. Would they increase the tax credit to a higher number, like 26%, which I think I have heard somewhere in the media, to make the bite less strong? It's hard to say, but that is one definitely to keep your eyes on if you see wind of that, and that'll require legislation. You can't do that in the agencies. That you have to do that with legislation, and that would be a good time to gear up and make sure you've got somebody advocating on your behalf up on Capitol Hill. Yeah, if that happens.
Yeah, thank you. Yeah, and plan conversations with our plan sponsors, that's definitely been the one that garnered the most attention.
It got a lot of attention in 2011 too, I will tell you.
So deferral limits. So, one thing we run into a lot with a number of firms, companies we work with is that highly compensated employees can't save the recommended 10 to 15% of income to be ready for retirement. We find this low cost of living increases to be annoying. We hear a lot, who's the government? Tell me how much I can save. Do you see deferral limit increases speeding up? What other options could we see? I think you mentioned a higher catch-up contribution at age 60 earlier.
Yes, I mean, that's out there. Generally, the trend in the last 20 years has been when they touch those limits, it's in the up direction. But a little context here, because this is something that, if you think about it for a moment, it kind of makes sense, but you've got to kind of put yourselves in the shoes of the government a little bit. The government needs funds to operate, and they get those from taxes. So the government position on retirement, remember, when you put money in a 401k or an IRA and get a deduction, that's less money, at least that year, that's less money for the government to operate. Now, someday down the road, when you retire and start taking that money out, it gets taxed at ordinary rates at that point. So the money does end up in the government's hands, but it might not end up in the government's hands for 20, 30, or 40 years. So from the government's position, they will not tell you, and the government's never done this before, they will not tell you how much of your after-tax money you can save. But they've always put limits around how much of your pre-tax money you can save, because by giving you that deduction, that makes it a pre-tax amount of money. $100 pre-tax is more than what you would have had after tax, correct? So if you get the deduction, you're putting in pre-tax money, and pre-tax money means lower revenues for the government to operate. So there's always been this balancing act. The government needs money to operate on the one hand, but the government wants to promote a secure retirement on the other hand. So there's a trade-off, and the balance they've struck over the years is kind of reflected in these contribution limits. And for better or for worse, if you're a highly compensated employee, the government will always look at you as someone who's in a better position of providing for yourself without quite so much help from the government. Whereas if you're a non-highly compensated person, maybe not so much. Another thing I would say is a lot of these laws were enacted originally back in the 70s. 401k came into the code in 1978 and through the 80s. It really has been since then that the traditional pension plan has started to drift away and gone into almost into not quite extinction, but to become much a smaller part of the retirement world. And it's been after that that academics and studies and folks have policymakers have studied and come up with the notion that, boy, you need to save 13, 14, 15% of your pre-tax money, or maybe after tax, in order to have enough for retirement. Well, a lot of those studies came along after a lot of these laws were already baked in. So I'm not saying they won't increase the limits. They talk about it all the time, usually though in the context of catch-up. But the idea of increasing the COLA, increasing the amount of the COLA is probably not something you're hearing much. In fact, there's a provision buried in the bowels of the reconciliation bill right now to put a freeze on all the COLAs beginning after 2030. Now that may seem strange to you, but that's part of the sausage making of a reconciliation bill. They need to save money, not just, they can spend money in the 10-year window up until 2030, but after that, they need to start saving some money. And sometimes they'll throw in a provision that they plan on, it doesn't really come into effect for a decade or so. And there's some negotiation on that right now, on that provision. And some people think that if it stays in the bill, and we're not sure it will, but if it does, some people think it'll be reversed quickly so that it doesn't actually go into effect. Because it wouldn't go into effect anyway until 10 years have gone. Okay. So I guess I would say to you folks that don't understand it, there have always been limits. There almost always will be limits around pre-tax savings, but that's at least to give you a sense of the concept behind why they're there in the first place.
Great, thank you. And lastly, and just being mindful of our time, so we have a little talk on student loans. So, there have been some student loan initiatives coming out of Secure. Do you think there's more to come down the line on those things, emergency savings, other new programs?
I do. The student loans initiatives and the emergency savings are probably two of the most popular and most bipartisan ideas on the Hill right now. The question is what form will they take? So with student loans, the simplest thing to do would be to say, if a person makes a student loan payment, you can treat that like a 401k contribution, the employer can, and then the employer can put a matching contribution, based on how much that loan payment was, put a matching contribution into the plan. That's not in the statute right now. That is probably the most popular. Another concept is to change the non-discrimination testing rules, which is more complicated and probably less likely. But the concept there would be if students if people still paying on student loans are doing that instead of putting money in the plan, maybe they're making the plan look a little out of balance. The highly compensated people are still putting money in, and the newer employees are not. So there's a lot of work around that. I think at the end of the day, the concept that will go through in one fashion or another is probably to treat the student loan payment as the equivalent of a 401k contribution, as long as there is an outstanding student debt and they're actually making the student loan payments. On the emergency savings, the main idea here is probably to add either a new savings product out there that's where you can put pre-tax money up to a much smaller limit, but a pre-tax savings account that allows you that you can get into it at pretty much any time you have an emergency. Now, of course, when Congress will have to define what's an emergency, and that's where it gets really complicated and technical probably. Or they might want to allow a portion of your 401k to be treated as an emergency, or they might want to increase. You were talking about these limits. increase the 401k limit, but make it like a side saddle amount of money that goes only into the emergency. Another way in which this is being discussed, the emergency savings I'm talking about, is maybe instead of creating a new account or creating a side saddle account, just go and revisit the existing hardship distribution rules and make those more amenable to the kinds of emergencies that come up on a more regular basis, and maybe beyond the kind of hardship that's caused by like a hurricane or a flood, the kind of natural disaster type hardships we've seen in the past, where Congress immediately, or even the agencies have allowed, like Treasury, have allowed people to take money out of their 401k in an emergency because of a flood or a hurricane. Do something about revisiting the hardship distribution rules. It's very hard to say which way Congress would go on that, but I will say that the concept of doing something on emergency savings, pre-tax savings for emergencies, and something on student loans, very, very much under discussion in both parties, and I would expect to see something on that in this Congress at some point. No guarantees, but it's definitely a discussion.
Something for our plan sponsor to look forward to, more things to have to document. So we have had a couple of questions come through during the conversation, and I was able to answer them, thankfully. So I think we can just be respectful of everyone's time. I'll give another minute if anyone wants to drop a question in the chat box. But while I do that, I will just say we really appreciate everyone's time today. I hope all of you got a great education from Preston. He has been a wealth of knowledge for us. He is now independent, running the Rutledge Policy Group, and available to consult to companies. That is his project now. And as you can see, there's a lot to be coming. So Preston, in 1 second, I'll let you give your contact information. For those of you who already know 12 Points, we'll be following those things closely. For those of you who may not, you certainly can reach us. I'm Dave at 12pointswealth.com. And Preston, why don't you give your contact information for everyone?
Well, thank you very much. My email is Preston. I'm trying to make this easy to remember. Preston at rutledgepolicy.com. Preston at rutledgepolicy.com. And also, I have a webpage, Rutledge Policy, www.rutledgepolicy. And on the webpage, I have some information about myself, but also media. I've started a blog, things like that. So those are the ways to get a hold of me if you'd like to. And I really appreciate your giving me the opportunity to give folks my contact information. I do think there's a lot coming, and it's important to kind of get involved early. I'll say that not just to promote, business. What I mean by that is, when you get involved early, you can see around the corners if you have someone helping you that knows how to kind of see what's coming down the road, and you can be ready before it happens, so that when it happens, you're in a much better position to make a difference. I think a lot of people look upon new developments as they take a long time to happen, and then they happen all at once. And that's sort of how legislation goes. People talk about concepts for years and years, and then suddenly it's on you. And it's good to be prepared in advance.
Absolutely. Well, thank you, everyone, for your time. We hope you enjoyed this and found it a valuable use of your time. And we will look forward to talking to you next month. Preston, thanks again for all your time and insight today.
Thank you. Have a great weekend, everybody. And thank you, 12 Points.
Thanks, guys.